Welcome back, everyone. You're with us on the deep dive, and today we're tackling a topic that, well, many of you will face at some point: selling your home.
That's right.
It can feel like a maze, right? All the rules, the numbers, but we're here to cut through that complexity. We want to highlight the strategies that can genuinely put more money back in your pocket.
Exactly. Our goal for this deep dive is really to demystify the tax side of selling your main home. We'll walk you through the key rules, show you the calculations, and maybe most importantly, pinpoint those opportunities for, significant tax savings.
Yeah, think of it as your shortcut to keeping more of your gain. I love that, because who doesn't want to save on taxes, right?
Absolutely.
So we're going to jump right into the massive tax exclusion available, uncover how things like home improvements can dramatically reduce your taxable gain, and reveal some maybe surprising scenarios where you might qualify for even more benefits. Prepare for some real aha moments. Maybe let's imagine someone, say Alex, who bought his first home 5 years ago and is now thinking about selling, just to make it tangible.
Good idea.
Okay, so Alex is thinking of selling. What's the very first, like the biggest tax benefit he needs to know about?
Well, Alex and everyone listening, here's your first big win. When you sell your main home, you can potentially exclude a huge chunk of your gain from your taxable income.
Huge chunk meaning.
We're talking up to $250,000 if you're a single filer, and a really remarkable $500,000 if you're married and filing jointly.
Wow.
It's essentially tax-free profit up to those limits.
$500,000 tax-free for married couples. That's incredible. Okay, so what are the strings attached? What conditions would Alex need to meet for that full exclusion?
Yeah, it's powerful, definitely. But it's not automatic. You need to meet what the IRS calls the eligibility test. It basically boils down to three core things: how long you've owned it, how long you've lived in it, and how recently you've used this exclusion.
Okay, break this down for us.
Sure, first, the ownership requirement. Alex, or at least one spouse if you were married, must have owned the home for at least 24 months. That's 2 years out of the 5-year period right before the sale date.
2 out of 5, got it.
Second, the residence requirement. You must have lived in the home as your main residence for at least 24 months out of that same 5-year period.
Same time frame. Okay.
Right, and this time living there, it doesn't have to be continuous, short absences like vacations, those still count. But here's a key difference for married couples wanting that full $500K. Each spouse has to individually meet this residence requirement, not just one, like with ownership.
Oh, okay. That's important.
Very. And there's also a compassionate rule. If you become physically or mentally unable to care for yourself, time you spend in a care facility can count towards that residency time.
That's good to know. And the third thing?
The third is the look-back requirement. Pretty simple. You can't have sold another home and claimed this specific exclusion within the 2-year period just before your current sale. You get this valuable break, but only once every 2 years.
Okay. So if Alex hits all those marks, owned it long enough, lived there long enough, hasn't used the exclusion recently, he's good, he gets the full amount.
Generally, yes. But are there immediate red flags, things that would just stop you?
Yeah, like automatic disqualifications.
Yes, there are two main ones. First, if you got the property through a like-kind exchange, a 1031 exchange, usually for investment properties within the past 5 years.
Okay.
Or second, if you're subject to expatriate tax. If either of those situations applies, then this main home exclusion is, well, it's off the table for that sale.
Gotcha. Okay, so what if life throws Alex a curveball? You know how it is. Maybe he needs to sell sooner than expected, doesn't quite meet that 2-year mark for living there, say. Is he just out of luck, or can he still get some tax relief?
Absolutely not out of luck, potentially. And this is where it gets really interesting for a lot of people. Even if you don't meet the full 2-year tests, you might still qualify for a partial exclusion.
A partial one. How does that work?
It applies if the main reason for your sale was something specific the IRS recognizes. Primarily, that's a work-related move, a health issue, or what they call an unforeseeable event. Basically, the IRS acknowledges that sometimes life forces your hand.
Okay, so what counts? Like, what if Alex gets a great job offer, but it's across the country? Or maybe there's a family health emergency.
Great questions. Those could definitely qualify. For a work-related move, it typically applies if the new job is at least 50 miles farther from the home you're selling than your old job was. Or if you didn't have an old job, the new one is at least 50 miles away. That 50-mile rule is key.
Makes sense. And health.
For a health-related move, it covers moving for, say, diagnosis, treatment, or care for yourself, or a pretty wide range of family members, or even if a doctor recommends you move because of a health problem.
Okay. And unforeseeable events. That sounds kind of vague.
It is broad, which can be helpful. It includes things like your home being destroyed or condemned, a major casualty loss from a natural disaster, the death of you, your spouse, or a co-owner,
Wow. Okay.
divorce, having twins or more from one pregnancy, becoming eligible for unemployment benefits, or even just a change in employment that makes you unable to pay basic living expenses. And they even have a catch-all. Other facts and circumstances can qualify if you can show the primary reason fits into one of those main categories: work, health, or unforeseen. So yeah, significant safety nets there.
Those are incredibly important exceptions. They could save someone a lot of money if they have to move unexpectedly.
Yeah.
What about even more specific situations? I think I've heard something about special rules for, like, surviving spouses or military members.
You're right, and these are really crucial tax saving points for certain groups. Let's take surviving spouses. If your spouse passes away and you haven't remarried when you sell the home, you can actually count the time your late spouse owned and lived in the home towards your ownership and residence requirements. That's a big help right there.
Definitely.
And even better, potentially, you might be able to claim the full $500,000 married exclusion instead of just the $250,000 single limit.
Oh, really? How?
If you sell the home within 2 years of your spouse's death, you haven't remarried before the sale, and neither of you had claimed the exclusion on another home sale within the 2 years before their death.
That's a huge potential benefit for someone in a difficult situation. What about service members?
Yeah, for service, intelligence, and Peace Corps personnel, there's a really helpful rule. If you or your spouse are away on qualified official extended duty, you can choose to basically pause the clock on that 5-year test period. You can suspend it for up to 10 years.
10 years. Wow. So what does that do?
It means you can still meet the 2-year residence test even if your military duty physically kept you away from your home for much of that 5-year window. It stops service members from being penalized just for serving their country. A really great provision.
That's fantastic. Any other sort of niche ones?
Well, there's vacant land. Sometimes if you sell vacant land that's right next to your home and you owned and used it as part of your home.
Like an extra lot.
Exactly. If you sell both the house and the land within 2 years of each other, you might be able to treat it as part of the home sale for tax purposes. But it's one single transaction, meaning only one exclusion amount applies to the combined sale.
Interesting. And you mentioned 1031 exchanges earlier as a disqualifier.
Yeah.
Any interaction there?
Right, the like-kind exchanges. It's a bit nuanced. If you acquired your main home in a 1031 exchange, you generally can't use the exclusion if you sell it within 5 years. That's the disqualifier part.
Yeah.
However, let's say you had a rental property you got through a 1031, and then you converted it to become your main home. If you later sell it, the main home exclusion rules, what we're talking about today, generally apply before the 1031 rules. Meaning you could potentially exclude some gain under the main home rules up to your limit. But crucially, any depreciation you took back when it was a rental, that part would still likely be taxable. It doesn't just disappear.
Okay, lots of specific rules there. So we've covered the big exclusion, the partial ones, the special cases. But before Alex can even think about applying any exclusion, he needs to know, did he actually make money? Does he have a gain or maybe even a loss?
Exactly. You have to calculate that first.
So walk us through the actual calculation. How do you crunch those numbers?
Okay, it's a pretty straightforward formula to start. You take your selling price minus your selling expenses. That gives you what's called the amount realized.
Amount realized. Got it.
Then you take that amount realized and subtract your adjusted basis in the home. That final number is your gain or loss.
Okay, selling price minus expenses equals amount realized. Amount realized minus adjusted basis equals gain or loss.
You got it. If that final number is negative, you have a loss. Unfortunately, for a personal home, you generally can't deduct that loss on your taxes. But hey, the silver lining is you don't owe tax on the sale either.
Right. And if it's positive?
If it's positive, you have a gain. And that's the number that your exclusion, the $250K or $500K, can potentially wipe out, saving you taxes.
Okay, let's break down those pieces. Selling price, that seems obvious, but what exactly counts?
It's basically everything you received from the buyer. So, the cash, obviously, but also the fair market value of any other property or services they gave you. It also includes any of your debts the buyer agreed to take over, like maybe part of the mortgage, and any real estate taxes you owed but the buyer paid for you. Also, if someone paid you for an option to buy your house and then exercised it, that amount counts too.
What doesn't count?
Good question. Don't include money you got specifically for selling personal property, this furniture you sold separately with the house. And don't include reimbursements your employer might give you if you're moving for a job transfer. Those are usually handled differently, often as regular income.
Okay. Next part, selling expenses. What are those?
These are your direct costs of selling the home. Think real estate agent commissions.
The big one, usually.
Definitely. Also, advertising fees, legal fees related to the sale, maybe escrow fees, and sometimes mortgage points or loan charges you paid for the buyer that would normally be their responsibility. These expenses are a really great tax-saving tool because they directly reduce your amount realized. So every dollar in selling expenses is a dollar less potentially subject to tax. Think of them like immediate deductions against your sale price.
Nice. Okay, so we've got selling price minus those expenses. That gives us the amount realized. Now, the big one you mentioned, adjusted basis. This sounds important. You said this is where the magic happens for minimizing gain.
You're absolutely right. This is probably the first big aha moment for real tax savings. Your home's cost for tax purposes, its adjusted basis, is almost never just what you originally paid for it. This is where you can really minimize that taxable gain.
Okay, tell us more. How does Alex figure out his adjusted basis?
Well, you start with your initial cost. That's generally what you paid for the home itself, your down payment, plus any mortgage debt you took on to buy it. If it was a co-op apartment, it includes what you paid for the shares in the corporation.
Okay, the starting point.
Right. But then you get to add certain costs to that basis. And every dollar you add here is a dollar less gain later on. This is huge.
What kinds of costs can you add?
Things related to buying the home initially, certain settlement fees and closing costs you paid when you bought it. We're talking things like abstract fees, maybe legal fees for checking the title or preparing the deed, recording fees, survey costs, transfer taxes paid at purchase, and the cost of owner's title insurance.
So dig out those old closing documents from when you bought the place.
Absolutely essential. Keep those records safe. Things like fire insurance premiums or rent you paid before closing, those generally don't count, though.
Okay. What else adds to basis? This sounds like the good part.
It is. The other major category, and this is where homeowners often miss out, is improvements.
Improvements, okay, like renovations.
Exactly. Any major project you've done that adds value to the home, significantly prolongs its useful life, or adapts it to new uses. Think big things. Adding a bedroom, a new bathroom, finishing a basement, a major kitchen or bath remodel.
What about system upgrades, like a new roof Alex put on last year?
Yes.
Or central AC?
Yes. New roof, central air conditioning, installing a new furnace, putting in a security system, paving the driveway, adding significant landscaping. All these things generally count as improvements and increase your basis. Even sometimes repair-type work, if it was done as part of a larger remodeling or restoration project, can count.
That's huge. So keeping receipts for all that work is critical.
Critical is an understatement. This is probably the single biggest area where homeowners can actively reduce their future tax bill just by keeping good records of those improvement costs.
Yeah.
What doesn't count generally is just regular maintenance, painting a room, fixing a small leak, replacing a broken window pane. Those are repairs, not improvement.
Got it. Repairs maintain, improvements enhance.
That's a great way to put it. You can also add the cost of any special assessments you paid for local improvements, like new sidewalks or sewers in your neighborhood. And amounts spent to restore your home after a casualty, like fire or storm damage, can also be added to basis.
Okay, so adding those things to the initial cost reduces the potential gain. What about things that go the other way? Things Alex might need to subtract from his basis, which would increase his gain.
Good question. Yes, there are subtractions too. These are generally benefits you've already received related to the house. The biggest one for many people is depreciation.
Depreciation on a personal home.
Only if you used part of your home for business or rental purposes after May 6, 1997. If Alex had a home office and claimed deductions for it, or if you rented out a room, he likely claimed or could have claimed a depreciation deduction on that portion of the home each year. That deduction represents the wearing out of the business part of the property.
Okay, so what happens when he sells?
When he sells, the IRS essentially wants that tax benefit back. That total amount of depreciation he took, or could have taken, after May 97, generally has to be recaptured. It gets subtracted from his basis, and that specific amount of gain is typically taxed as ordinary income, not capital gains. It's a really important point for anyone with a past home office or rental use.
Wow. Okay, so depreciation claimed reduces basis and gets taxed differently. Anything else subtracted?
Yes, any casualty losses you previously claimed as a tax deduction related to the home, you'd subtract that. And any insurance payments you received for those losses that weren't used for repairs would also reduce basis. Also, if you claimed any energy credits, like for solar panels or energy efficient windows, and you also included the cost of those improvements in your basis, you generally have to subtract the amount of the credit you received. You can't double dip the tax benefit.
Makes sense.
And a couple of others. Certain mortgage points the seller paid for you when you bought the house, and any canceled or forgiven mortgage debt on the home that you were able to exclude from your income under specific rules that were in place before January 1st, 2026.
How you got the home matters too, right? Like inheritance.
Absolutely. Your starting basis can be very different depending on how you acquired it.
Yeah.
If you inherited a home, your starting basis is usually the fair market value of the property on the date the person died. This is often called a step up in basis and can be a huge tax advantage.
Okay. What about a gift?
If you received the home as a gift, it's usually more complicated. You typically take the donor's adjusted basis, what they had invested in it. But there are adjustments depending on the fair market value at the time of the gift and whether any gift tax was paid.
And divorce.
If you received the home in a divorce settlement, your basis is generally the same as your former spouse's adjusted basis was right before the transfer. It's treated as carrying over. So knowing all these details about your adjusted basis is absolutely fundamental for figuring out your real gain and maximizing your tax savings.
That's a lot of detail, but incredibly valuable stuff. Okay, so what if Alex's situation was a bit more complicated? Maybe his home wasn't just his home. What if he had that home office we mentioned? Or maybe he rented out the basement apartment, or even rented out the whole house for a year while he was away. How does that mixed use affect the exclusion and savings?
Right. This is where the rules definitely get more intricate, but understanding them is key to avoiding unexpected tax bills. It really hinges on how that business or rental part was integrated with the home.
Okay, how so?
Well, let's say Alex used a space within his actual living area, like that spare bedroom, as a home office, or maybe he rented out an attic room. In that case, he generally doesn't have to treat the sale as two separate transactions, one personal and one business. It's still mostly treated as the sale of his home.
Okay, that sounds simpler.
And this is the crucial tax planning point we touched on with bases. He cannot exclude the part of his gain that equals the depreciation he claimed or could have claimed on that office or rental space after May 1997.
Right, the recapture.
Exactly. That depreciation amount is still taxable, usually as ordinary income, and needs to be reported on a specific form for business property sales, Form 4797. The rest of the gain, though, is generally eligible for the main home exclusion.
Okay, so you calculate total gain, identify the depreciation part which is taxed separately, and then see if the remaining gain is covered by the exclusion.
Precisely. Now, what if the business or rental space was separate from his main living area?
Like, he lived in one half of a duplex and rented the other, or had a separate workshop out back he used for a business.
Exactly those kinds of scenarios. Or maybe lived above a store he operated. In these cases, where the business rental part is structurally separate or used entirely for that purpose, you generally cannot exclude the gain on that separate business or rental portion. Unless, by some chance, he also owned and lived in that specific separate part as his main home for 2 out of the last 5 years, which is unlikely for, say, a rented duplex unit.
So what does he do then?
He generally has to allocate everything, the selling price, the selling expenses, the adjusted basis between the part he lived in, the residential portion, and the part he used for business or rent, the non-residential portion. He calculates the gain or loss separately for each part. The residential part gain gets the potential exclusion. The business rental part gain is reported on Form 4797 and is generally taxable.
Okay, that sounds like more work record-keeping wise.
It definitely requires careful allocation. Now, there's one more layer here, a relatively newer rule about non-qualified use.
Unqualified use. What's that?
This applies if, after 2008, there were periods when you or your spouse didn't use the entire property as your main home.
Like Alex rented out the whole house for a year before he moved in.
Yeah.
Or maybe after he moved out, but before he sold it.
Exactly. Those periods of time when it wasn't your main home are considered non-qualified use. Think of your tax exclusion like a season pass for your home. You get the full benefit if you used it consistently as your main residence. But if you rented out your pass, meaning the house wasn't your main home for part of the time you owned it after 2008,
Yeah.
then a portion of your gain might not be eligible for the exclusion. Specifically, the gain that's allocable to those periods of non-qualified use is generally not excludable, even if you meet the overall 2 out of 5-year test.
So it reduces the amount of game you can exclude it.
Correct. You have to calculate the ratio of non-qualified use time to your total ownership time after 2008 and apply that ratio to your gain. That part isn't excludable.
Are there exceptions to this non-qualified use thing?
Yes, important ones. Any period of non-qualified use before 2009 doesn't count against you. Also, critically, the period after the last day you lived in the home as your main residence, but before you sell it, as long as it's within that 5-year window, is not considered non-qualified use.
Oh, okay. So if Alex moves out and sells it 6 months later, that 6 months doesn't hurt his exclusion under this rule.
Correct. That time is carved out. Also, any periods where you were away for that qualified official extended duty, military, etc., or temporary absences due to those unforeseen circumstances we discussed earlier, up to 2 years for those generally don't count as non-qualified use either. But still, this rule can be a surprising reduction in the excludable gain for people who rented their home out for significant periods after 2008.
Okay. Phew. So after doing all those calculations, figuring the initial gain, adjusting the basis up for improvements, subtracting depreciation, accounting for any separate business use, and potentially reducing the excludable amount for non-qualified use, how does Alex finally figure out what, if anything, actually hits his tax bill?
Right, bringing it all together. The IRS has worksheets in their publications, like Publication 523, that walk you through this, but conceptually. First, you calculate your total gain, amount realized minus adjusted basis. Then you identify and set aside the amount of gain that's due to that recaptured depreciation that gets reported separately.
Yeah.
Then you look at the remaining gain. If the non-qualified use rules apply, you figure out what portion of that remaining gain is not eligible for exclusion because of those rental periods after 2008.
So that part's taxable.
That part's taxable.
Yeah.
The amount left after accounting for depreciation and non-qualified use is the gain that is potentially eligible for the main home exclusion.
Okay, the potentially tax-free part.
Exactly. You then compare that amount to your maximum exclusion limit, $250,000 for single Alex, or $500,000 if you were married filing jointly. If your eligible gain is less than or equal to your limit, fantastic. The entire eligible gain is tax-free. You don't report it as income. If your eligible gain is more than your limit, then the amount up to your limit is tax-free, and the excess amount above your limit is your taxable capital gain.
That makes the final step much clearer. So when does Alex actually need to report anything about this home sale on his tax return? Does he always have to file something?
Not always, which is nice. You generally only need to report the sale on your tax return if one of these is true. 1, you have a taxable gain, meaning after applying the exclusion, there's still some gain left over that you owe tax on.
Okay, makes sense.
2, you receive a Form 1099-S. This is a form that the closing agent or realtor often issues, recording the gross proceeds from the sale to you and the IRS. If you get one of these, the IRS expects to see the sale reported on your return, even if the gain is fully excludable. You'll show the sale and then show how the exclusion zeroes out the taxable gain.
Ah, okay. So getting that form triggers reporting. What's the third case?
Third, if you choose not to claim the exclusion, even if you qualify, why would you do that? Maybe you sold this home but plan to sell another main home within 2 years, and you anticipate a much larger gain on that second home. You might choose to pay tax on the smaller gain now to preserve the exclusion for the bigger gain later, since you can only use it once every 2 years.
Interesting strategy point. So if none of those apply, no taxable gain, no 1099-S, and you want the exclusion, then what?
Then generally, you don't need to report the home sale on your tax return at all.
Okay. But if Alex does need to report it, which forms are involved? You mentioned a few.
Right. If he has a taxable capital gain, the amount exceeding his exclusion, he'll report it on Form 8949, Sales and Other Dispositions of Capital Assets, and carry the totals over to Schedule D, Capital Gains and Losses, which attaches to his main Form 1040 tax return.
And that's where he'd show if it's short-term or long-term gain.
Exactly, based on how long he owned the home. He might also look into whether investing the gain in a qualified opportunity fund could offer deferral or exclusion, though that's a whole separate topic.
Okay, what about the business use stuff? the depreciation recapture.
That goes on Form 4097, Sales of Business Property. This form is specifically for reporting gain or loss from business or rental property. Critically, it's where you report that recaptured depreciation, which is taxed as ordinary income, not capital gain. If he had that separate duplex unit, the gain on that would also go on Form 4797.
Got it. And if he, say, provided seller financing to the buyer?
Good point. If it's an installment sale where he receives payments over time, he'd generally report the income using Form 6252, installment sale income. And of course, any interest the buyer pays him on that loan is reportable interest income.
Okay. Any other related deductions or income Alex should be aware of when filing?
Yes, a few final details. Those transfer taxes or stamp taxes paid at sale. You generally can't deduct them directly, but remember, you can treat them as selling expenses. That's key. It reduces the amount realized, lowering the gain.
Smart. What about property taxes?
Real estate taxes. You can deduct the portion of the year's property taxes for the time you actually owned the home during the year of sale. This is usually prorated based on the number of days. The buyer deducts their portion. This deduction typically goes on Schedule A if you itemize.
Okay. Mortgage points.
If you paid mortgage points when you originally got your loan and haven't fully deducted them over the life of the loan, you may be able to deduct the remaining amount in the year you sell the home.
Okay. And crucially, anything Alex might have to pay back.
Yes, this is super important and often overlooked, paying back credits and subsidies. If Alex happened to get the first-time homebuyer tax credit, especially the one from 2008 that required repayment,
Yeah.
he might have to repay part or all of it when he sells, using Form 5405, even if his gain is fully excluded. Similarly, if he receives certain federal mortgage subsidies, like through mortgage credit certificates or qualified mortgage bonds, he might have to repay some of that benefit using Form 8828, again, even if the sale itself results in no taxable gain.
Wow. Those are really crucial details that could be an unpleasant surprise if you weren't expecting them.
Definitely things to check if they might apply to your situation. They can significantly impact your final tax outcome.
We have covered a tremendous amount of ground today.
Yeah.
Seriously. From that incredible potential tax-free gain up to $500,000
Yeah, the big win.
to how tracking those home improvements over the years isn't just good record keeping. It's actually a powerful tax-saving strategy that builds your basis.
Absolutely key.
And then all the nuances around partial exclusions, special rules for military or surviving spouses, mixed-use properties, that non-qualified use rule. This has been a truly comprehensive deep dive.
It really has. And, understanding these rules, it isn't just about filling out the forms correctly or just compliance. It's really about making informed financial decisions. This is likely your biggest asset, right? So knowing what actually counts towards your basis, knowing which selling expenses directly reduce your gain, knowing when life events give you a partial break, it truly empowers you to maximize your return and, frankly, save potentially thousands on taxes.
Absolutely. After listening to this, you are now so much more well-informed than the average homeowner heading into a sale, tax-wise. So what's the ultimate insight here? Maybe it's that the real tax planning for selling your home doesn't start when you list it. It starts way back when you buy it and continues every time you make a major improvement. That meticulous record keeping. It isn't just about tidiness. It's a proactive strategy that can literally save you tens, even hundreds of thousands down the road.
Well said.
Keep that curiosity alive about where else smart planning can save you money. Thanks so much for joining us for this deep dive. Until next time, keep learning, keep growing, and keep asking those important questions.